and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. is weighing a historic breakup of Google as a remedy to its monopoly case. Now, the DOJ may force Google to sell off parts of its operations, seeking to prevent it using products including Chrome and Android to its advantage. Pre-market, you can see Google down some 1.1%. Now, joining us to talk about the tech space, but also to talk risk in general, is Emmanuel Cau. He's head of European equity strategy at Barclays. Emmanuel, thank you for joining us. There's a lot going on. We have the U.S. elections. We have these very specific stories like, for example, the DOJ and Google. What do you see weighing on equities overall?
Good morning, Francine. We are trying to keep it simple, so very much focus on what matters. The U.S. economy, growth and rate outlook is what will shape, I think, the market into next year. We think the macro backdrop is pretty benign, right? You have a fairly resilient U.S. economy. The Fed is willing to support it by cutting rate. And then, as of 2 weeks ago, we've got the China put in play. China is willing to support the economy as well. So I think that should basically help growth to either stay resilient or somewhat improve into next year. Now, around that, you've got risk. The main one is pretty much a broad geopolitical issue. You have U.S. election. I think a lot of investors will wait to see what happened with the U.S. election in November before taking investment decision for next year. You've got the conflicts in Europe, in the Middle East, what happened to commodity prices. So there is a lot of things which are obviously disrupt this market and create headline risk. But we are trying to focus on growth and inflation outlook, and we still feel pretty good about this soft landing narrative.
Emmanuel, I was going to ask you about soft landing. So in a second, we'll be briefed really on what's happening at Google and the DOJ. But is there a concern that inflation really shoots up in 12 months? And so actually a lot of the Fed cuts are really not possible. And the first sign of that was a strong employment number.
Yeah, we got some of this repricing in Fed expectation after the payrolls last week. Look, there is no free lunch, right? Clearly, if growth is pretty strong in the U.S., if you have full employment, Fed won't cut too much. But again, CPI tomorrow will be quite important. As long as inflation is under control and tracking this kind of Fed target, the Fed has no reason to stay restrictive, right? So they will have to calibrate rate cuts depending on the inflation, and the market may have to price the risk of inflation coming back at some point. But right now, we're seeing you have, across the board, enough evidence of disinflation for central banks to cut, which is better than nothing, right?
Emmanuel, thank you so much. Let's also get a full briefing on what's happening at the DOJ. Let's bring in Parmi Olson from Bloomberg Opinion. Parmi, of course, is an expert on these things. So, Parmi, good morning. How significant is this latest Google antitrust development?
Good morning, Francine. Yeah, I'd say this is pretty significant. It's the most significant move since Washington tried to break up Microsoft about 2 decades ago. Interestingly, we have a lot of proposals on the table from the DOJ. It's almost a sense of throwing spaghetti against the wall to see what's going to stick. They are proposing the divestiture of Chrome or of Android and or of Google Play. That's the App Store. All those proposals are on the table. There's also the proposal to force Google to provide access to the underlying data that it uses to build its product, something that is actually raised some hackles in the industry. And there's also a proposal to stop or restrict Google from investing in other competitors and potential rivals, which is an interesting one, I think, because in the last year, as the AI race has really heated up, we've seen some of the most promising AI startups get hoovered up by large technology companies, but they're not strictly acquired. They are acqui-hired, so they hire all the staff in the company and then they spend a lot of money on licensing. So it's effectively an acquisition, but it's a clever way to get around antitrust scrutiny.
But, Parmi, could a breakup of Google actually happen? If you look at what we're seeing pre-market, I mean, the stock is barely moving.
Yeah, and I think that's a good reflection of what we've seen just over many years, which is that these companies like Google and Meta platforms and Apple and Amazon, they're all very, very good at kicking the can down the road when regulation comes their way. I mean, that's why we've had really no federal law from Congress to regulate these large tech companies, whether it's an antitrust measure or something to regulate the harms of social media, because these companies have armies of lobbyists and legal teams. And of course, with this case, there is already a plan to appeal it. There are other similar antitrust cases that are on the table for Google, with plans that it has plans to appeal those cases too. So I think that's one reason why there's a little bit of skepticism in the market that this is really that big a deal. But I think, I wouldn't completely dismiss it, because if you talk to people in antitrust circles, they say a year ago it would have been crazy to use this term structural remedies, which isn't just a jargon for a breakup. So there, in that sense, there really is what they would call progress. There is a much more momentum behind these efforts, and I would just say maybe that there's a possibility that something could happen if there is pressure from not only civil society, but regulators in Europe. That's one of the things that antitrust campaigners are pushing for, that for the U.S. to really make this work, for the DOJ to make it work, they need a little bit more help and support from governments in Europe.
Parmi, thank you so much, as always, for the terrific briefing. Parmi also there from Bloomberg Opinion, also with a new book out, which I recommend to everyone to read, called Supremacy, which is on AI, on DeepMind, but also open AI. Now, still with us, Emmanuel Cau from Barclays. Emmanuel, we were talking a little bit before about the pitfalls of some of these tech stocks. We were also talking about the fact that you're still expecting a soft landing in the U.S. Now, yesterday we spoke to Jamie Dimon, and he really played up the U.S. book. He says there's so much more value in the U.S. than the EU. When does Europe catch up?
Well, we still don't know. I think there is a case for Europe to perform better cyclically if everything goes well in the world, right? So the structure of the index in Europe is very cyclical, right? So we saw that 2 weeks ago with the Chinese stimulus. Europe was the best market on the week. So you can have some catch-up if the global growth environment is improving, and most importantly, if China is really picking up. But I think structurally, we still believe that U.S. is where you want to be invested for the long run. You have a strong tech sector, which so far is dominant globally, but you also have a chance for non-tech equities to catch up if this soft landing is coming through, right?
Let's listen to what Jamie Dimon told Lisa Abramovitz.
NASDAQ and New York Stock Exchange, they're just more attractive places to go, and we'll see how that pans out. I'm not in favor of just advantage in the United States at the expense of Europe. But I do think that Europe needs to focus on Mario Draghi's report. There are a lot of things in there that they need to do to get productivity back and growth back and markets back. They need the capital markets union, for example, which they've been talking about for years. They actually do really need it to foster growth around European countries.
But Emmanuel, at the same time, we're seeing quite a lot of weakness in data. So does it give more scope for the ECB to be a little bit more accommodative than maybe the Fed is?
Yeah, fully, because there is no much to hope for in Europe. You have a lot of this political fragmentation, which makes structural reform very hard to deliver, and you have little fiscal capacity. We are seeing in France, in Italy, talk about higher taxation, weaker spending on the back of that. So you're left with the ECB as the only potential source of growth. And yes, we do believe that the ECB has to do more. We can talk about how much the Fed should be cutting if growth is very strong in the US. I think there is less and less doubt that the ECB has to cut, and not so much for the good reason, because growth is quite weak, inflation is coming down as well. So ECB should help, and that's why we think that maybe from a tactical standpoint, being tilted towards European exporters that could benefit from a softer euro and somewhat stronger global growth might be the place to be.
Europe, so you're looking at industries, or are there certain countries that also look more attractive?
No, look, I think the trend for the past 12 months was to be long European banks, long defensive sector like utilities, real estate. We think now we should go back in some of the China plays. So we've been very bearish on auto sectors. We still believe the sector is challenged, but we closed our underweight last week. We think as some of the exporters like semiconductor, chemicals, materials as well, might start to look interesting again if market is getting more comfortable with the global growth environment. And on top of that, ECB is cutting enough to put the cap on the euro dollar.
Emmanuel, thanks so much. Emmanuel Cau from Barclays stays with us. We'll talk a little bit more about currencies and some of the things, of course, that could be changing in the next couple of months. Coming up, Kamala Harris ramps up pressure on rival Donald Trump after a new report claims he helped Russia during COVID. That's next, and this is Bloomberg.
I can't run for president, and there was no opening. I mean, there's no way that it was even possible. So it's a little flattering, but, I just want to help our government do the right stuff. I think there are a lot of things to do to make America far better off. And particularly, because I've mentioned this many times, a lot of things we've done which I think are bad, whether you're Democrat or Republican, we support, it's often done in the name of good, have hurt the lower 20%. They're dying younger, their incomes didn't go up for 20 years, they're the ones who have more crime-ridden neighborhoods, their schools don't work. We should acknowledge that as citizens and do something about it. Like I said, a lot of policies put in place have the exact unintended consequence, and that's where they hurt. Like, for example, growing the economy well, the people that help the most at the lower end. And I think we have to be very clear-headed about how we can accomplish what we want to accomplish to lift up all of America.
You haven't endorsed a candidate, and I wonder why. Is it because you think, as the leader of a big company, you've got to work with anyone? Or is this just that you can't decide this particular time around? I
will decide, okay, and I will vote. I reserve the right to do whatever I want. Okay, I'm a citizen. I can vote. I can say what I want, and stuff like that. I've never been in the practice of endorsing candidates, and so. But I'm thinking through what I want to say or do or something like that.
Well, that was the J.P. Morgan Chief Executive Officer, Jamie Dimon, speaking to Bloomberg's Lisa Abramovitz here in London. Now, staying with the U.S. election, of course, Republican nominee Donald Trump is this morning in the headlines after being accused of sending Russian President Vladimir Putin COVID-19 testing devices during the height of the pandemic. Now, his rival, Kamala Harris, said the news summed up who Donald Trump really is. We're joined by Bloomberg senior writer Stephanie Baker, who also has a book out on Putin that came out a couple of weeks ago. So, Stephanie, good morning. Emmanuel Cau is also with us to try and understand the risk and the opportunities for the U.S. economy on the back of the election. But what's the significance of Trump and Putin talking after he left office?
Well, this just raises more questions about the relationship between Donald Trump and Vladimir Putin. It's more significant than, in my mind, sending COVID testing equipment to Russia, which we knew about, that there had been an announcement. We didn't know it was for Putin's personal use. But more significant is the fact that they were talking as many as 7 times, according to this report, after he left office, and including earlier this year when Trump was lobbying against additional aid to Ukraine. And so I think this is going to be a huge question going forward. There'll be attempts to confirm this. So far, the Trump campaign has denied that this happened. But if you remember, in the debate with Kamala Harris, he made a cryptic remark saying, when I last saw Putin after I left office. And that left a lot of people questioning when were they in touch?
So, Stephanie, I mean, does that matter to the voters of the U.S.? Do we know what they told each other in these meetings? Because I guess it's not unusual from, sitting presidents and former presidents to talk even once one leaves office.
Sure, it's not unusual, and Trump has met other world leaders, including Viktor Orban of Hungary and Netanyahu, but that has all been in the public sphere. There's been no attempt to hide it. Yeah. And I think the fact that this has been kept behind closed doors, not disclosed to the public, makes it all the more suspicious as to what's really going on here. We don't know what they discussed. I do think it will play out in the U.S. election. It will be another line of attack that Kamala Harris can use, and we saw that she did that already, both in the 60 Minutes interview that she did on Monday night and the Howard Stern interview, saying if Trump were in charge, Putin would be in Kiev. And I think it's a real dividing line. It's something I did cover in my book, that Trump does have a different relationship to Putin and was against sanctions, for instance, on Russia, despite what his national security advisors were telling him to do.
Stephanie, the polls are so close. What's at play in the next 4 weeks?
It is so close. I mean, you do see a more recent New York Times poll that came out yesterday with Kamala Harris pulling ahead, but Trump still leads on the crucial question of the economy, which I think is going to be the deciding issue in this election. And I think all eyes should be on the state of Pennsylvania. Kamala Harris has to win Pennsylvania. It's very difficult for her to get to 270 electoral college votes without winning Pennsylvania. And in there, it's a virtual dead heat. It's very hard to predict.
Stephanie, thank you so much. Stephanie Baker, a Bloomberg senior writer. You'll be seeing a lot more of her, of course, on TV covering the election, and also author of Punishing Putin. Emmanuel, I mean, no matter how you slice this, I mean, this is not only politics. This has a direct impact on what kind of U.S. economy we'll have, be it trades, tariffs, or extra spending. It's too soon to call. So how do you do it for, tactically buying equities or not?
I think we have very little risk exposure right now, directionally, in terms of thematic approach as well. I mean, as you said, I think a lot of the macro outlook for next year, the investment outlook, will depend on the outcome of the U.S. election. I don't speak to many investors who have strong conviction on what is going to happen. I think they know how to position once we know who is going to be in charge and what is going to be the Congress doing as well. So I think people will be on wait and see mode. If you look at the typical market behavior into the U.S. election, it's pretty much flat to down. So the market always struggles into the U.S. election and usually rebounds afterwards once we have some clarity. I think the main concern for many market participants is the risk of unclear outcome, right? If the election is contested in particular and take us into January without knowing who is going to be the next president, that will be, I think, the risk-off scenario for market. As it stands, I think people are a bit more nervous about Europe, China, the rest of the world if Trump wins to win the election.
Emmanuel, you were very clear. It's basically trying to keep it simple, right, given all of these outside risks coming from everywhere. We mentioned China. We mentioned the U.S. What are you expecting in terms of earnings season? So we start with the U.S. Thursday, Friday, and then we get onto European ones. Does that make a material difference to where you want to be invested?
I'm not sure. I think it's going to be a tricky one. I mean, clearly you have seen a number of profit warnings. Growth was pretty mixed in Q3. So I don't think people who should expect great numbers and much more clarity from companies. We're going to see dispersion within the market. As I said before, we are willing to re-engage with cyclicals, which have a global exposure, whether it's China or US, and we like those which have already gone through some kind of clearing event and had a bunch of resetting expectations.
What about the UK? So we have a global investment summit on Monday coming up in a couple of days. And then, of course, it's budget day, October 30th.
UK is a hot market again. We are seeing global investors looking at it, and the domestic economy is showing sign of life. We are seeing this rate cut, this disinflation, supporting consumer. I think the big one is what is the government going to come with on the 30th of October? Are we going to see some kind of fiscal tightening that would, again, raise a question about growth outlook in the region? But I think there is some appetite to go back in the UK on the back that now you have political stability. You may see some kind of softening Brexit as well. And again, broadly speaking, you have this support from the central banks in the backdrop of a very strong labour market.
Emmanuel, thank you so much. Emmanuel Cau there from Barclays. Now, coming up, Gucci has named a new chief executive to help lead a turnaround for the luxury brand. We'll have details next. And this is Bloomberg. Now, the Pentagon says a U.S. visit by Israel's defense minister, Yoav Gallant, has been postponed. Well, Bloomberg has learned it's because of last-minute objections from the Israeli Prime Minister, Benjamin Netanyahu. Now, Axios is reporting that President Biden is due to speak with Netanyahu later today. The French government has survived a no-confidence motion brought by leftist lawmakers. Now, the motion received just under 200 votes, far short of the 289 needed to topple Conservative Prime Minister Michel Barnier. Now, the socialists say President Macron should have appointed a premier from the ranks of the left-wing coalition since the alliance won the most seats in July's snap election. And Brazil's Supreme Court has authorized the reopening of social media platform X after chief executive Elon Musk complied with its demands. Now, those included removing some user accounts and appointing a legal representative in the country. The order ends a feud between Musk and Brazil's Supreme Court, which had gone on for a month. And Kering has named Stefano Cantino as the new Gucci chief executive to lead a turnaround at the French luxury group's biggest label. Now, he will assume the role on January 1st. High-end goods have been suffering from cooling demand, particularly in China, while Kering shares are higher this morning. Coming up, we'll be hearing from Jeff Currie, Chief Strategy Officer at Energy Pathways at Carlyle. We'll be getting his views on China stimulus, a read across for commodities, but also we'll talk about some of the hurricanes in the U.S. This is Bloomberg. good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The U.S. Justice Department weighs breaking up Google as a remedy for its monopoly case. Well, Google says splitting off Chrome or Android would, quote, break them. Hurricane Milton regains Category 5 strength as it continues towards Florida. We'll have the latest live from Tampa. And oil edging higher as hopes rise for more stimulus in China. We'll speak with Jeff Currie from Carlyle later this hour. Now, Hurricane Milton regained Category 5 strength, with residents fleeing the coastline ahead of its expected overnight landfall. Now, President Biden warned that the hurricane is likely to have a severe impact.
The current path of the storm is expected to Tampa Bay area and cut directly across the state, east to west, all the way across the state, with the potential for this storm to both enter Florida as a hurricane and leave Florida as a hurricane on the Atlantic coast. This could be the worst storm to hit Florida in over a century. And God willing, it won't be, but that's what it's looking like right now.
Well, let's bring in Rena Roy from ABC News in Tampa. Rena, thank you for joining us. I mean, it's expected this storm to inflict widespread damage and put lives at risk. What's the latest on the ground?
Yeah, well, Francine, I can tell you that 6 million people across 11 counties right here in Florida are under mandatory evacuation orders, with Milton now just hours away from making landfall. It is expected to hit as a Category 3 or 4 hurricane late tonight into tomorrow morning, bringing up to 18 inches of rain and a record storm surge of up to 15 feet in the Tampa Bay area. And it has the potential to be one of the most destructive hurricanes on record for the state of Florida. It is unclear where exactly landfall will be, but at last check, the path was veering slightly more south towards Sarasota. The governor says the National Guard storm mobilization is likely the largest in state history, with thousands of troops activated. 34 search and rescue planes are on standby, and 37,000 linemen are either in Florida or they are on the way to help with power outages. And some areas, including Charlotte County, which is just south here of Tampa, have extended evacuation orders at this hour. They're moving further inland because of storm surge concerns. Francine?
Rena, thanks so much. Rena Roy there from ABC News. Keep safe out there. Now, oil edging higher after tumbling the most in more than a year in the previous session. The market, of course, monitoring developments in the Middle East, as well as a new fiscal policy briefing from China. So for more on all of this, we're joined by Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle Group. So, Jeff, thanks so much for joining us. Just to make it clear, I mean, Hurricane Milton should not touch anything, any of the implications. So we can remove that to one side, certainly when it comes to the price of oil. The Middle East, though, is a huge concern.
Absolutely. And, you know, to borrow Javier Blas' term in his recent piece, is the potential mother of all oil supply disruptions. Because we're not only talking about, Israel striking energy infrastructure inside of Iran. Once Israel does it, it opens up, it gives the green light to Zelensky to do it to Russia. And then the retaliation coming from, Iran into the other side of the Gulf, or Russia into it just opens up a can of worms that we haven't seen since the 70s.
But Jeff, the market is, largely shrugging it off. So what's going on?
Yeah, I think it's to the broader point that the market in oil commodities more broadly has been unwilling to hold a position on anything, whether if it is, look through the current, uncertainty around China to see for the stimulus as it's going to improve. And I think it goes to that short-term, near-term myopic approach of trading oil. Where do we see the positioning in oil? It's in the options, which is part of the reasons why we see big moves like yesterday, down 3, up 3, that kind of moves, because you do have positioning in the options because it's the easier way to hold the position. But overall, open interest in oil, it's at a one-year low. The market is not long, it's not short. Positioning is really weak. Okay,
but so by your calculations, first of all, what's the risk of a significant supply disruption? And, I mean, could oil just go to $100 all of a sudden?
It's never been this high in our lifetimes. Well, I wasn't around in the 70s to, trading oil at that point in time. But in the time I've been doing this for 3 decades, I've never seen it this high. And I think, one of the differences, we have more transparency of it, and we can find out when it's going to happen and know what the infrastructure that could be hit here. And by the way, it's more likely to be refineries than it is to be, upstream oil assets. But I think the key point here is it's never been this high of a probability. And we're talking low inventories.
So you think it's never been, the probability of a significant supply disruption has never been so high in the last 40 years?
It's probably in that 30% plus range, if not higher. And we look at the complacency of the market, both from the disinflation narrative. We look at positioning in oil, but let's take the war out of the picture. The underlying demand dynamics in oil are very supportive right now. You have, let's start with the U.S. You just had rate cuts on top of, a gangbuster jobs report. The dock workers just got huge pay raises, so that's U.S. You have liquidity going up. Let's turn to China, a stimulus package, liquidity going up there, even a growth impulse coming out of Europe. You put the three together, you have global liquidity turning up, growth impulse turning up. That's the ideal time to buy commodities.
Right, but so are you telling me that oil should be at $100? I mean, if you're saying there's a 30% chance of a severe supply disruption, these, the market just doesn't make sense.
Take the supply disruption out. The market should be trading in that $80+ range. So, I think you put that supply disruption on top of that. How do you handicap that? We should be sitting, at least $10 higher than where we are right now.
So should OPEC Plus actually delay their production increase that they're expected to do in December?
Well, if we look at overall demand, it's improving. That the market is in a deficit. That's the part that the forward curve is backwardated. There's this belief of this oil supply glut, but the evidence of it, I think, is not that substantial. And I think the bottom line is, the overall demand is above supply. There is room for them to bring on that production.
Even next year?
We don't know. Like when we look out over next year. The forecast of that surplus keeps coming down. The EIA put one out yesterday of 200,000 barrels per day. That's getting close to zero. But how do we know what's going to happen to Saudi Arabia? Are they going to replace Iranian production in 3 weeks' time? We don't know those things. And so I think taking a strong view, we're in a surplus because fears around Chinese growth when they just, hit the stimulus button, and the onshore people believe it more than the offshore people. You look at production in the U.S., it disappointed yesterday. It came back down. So that growth is not materializing. And then we look at the spare capacity in places like Saudi Arabia. It could be swapped out for Iranian production in 3 weeks' time. So why is this bearish impetus in the market is beyond me.
But Jeff, I mean, when I hear you speak, there's nothing really that the market is getting right about this, right? Not the oversupply next year, not what's happening now, not the pricing next 3 months.
I think what's going on is it's too hard to hold the position, and they don't want to hold it. We're, up, down, $3 a day. That type of volatility, it's easier for me to sit here and talk to you about it than to actually somebody trying to hold the position.
Right. But, so when does that change? Again, if we talk about a war premium, what needs to happen for that to be
I think that the market's in that show me mode. They actually want to see it. They're not going to price it in until they actually see it, which unfortunately will be too late. And I think that it's the same thing in some of the other markets like, copper and the rest of them. They're in that show me. They're unwilling to hold a position until they see the fundamentals. They got to see it actually happen before they put it on. It's that momentum, the momentum type strategy. So it's not there right now. Instead, it's this as opposed to that.
What happens if oil goes to 100? What happens to the U.S. economy? Does it unravel, given we've had concerns about inflation going up after that blowout jobs report as well?
Well, I think obviously it would have we'd seen yields back up higher and have an impact on the equity markets. But in terms, let's remember, the U.S. is long oil. $100 oil will be good for the U.S. economy. That's the net. It exports oil. It's no different than Saudi Arabia, and that's part that it's just lost on me.
but it changes U.S. elections, doesn't it?
Yes, it changes U.S. elections. And I think that you look at the voting patterns in the U.S. and what's important, inflation and economic growth are sitting there at the top, and other issues like foreign policy are at the bottom.
Okay, Jeff, thank you so much. Jeff Currie from Carlyle Group stays with us. We'll talk a little bit also about gold and copper. Now, these are also live pictures of the BNEF Summit in London, a flagship event where energy, finance, and technology discussions converge. And our very own Tom McKenzie is in conversation with Guido Brusco, the Chief Operating Officer of Eni. Now, terminal subscribers can follow that discussion about the energy transition on Live Go. This is Bloomberg.
So we talked about the difference in terms of your strategy versus some of your European competitors. We know that BP and Shell have been walking back, or at the very least rethinking how much they want to be investing and how much they want to go back to the core parts of the product. Arguably, your US competitors have done essentially nothing on the renewables front. Is that setting them up longer term for a missed opportunity?
Welcome back, everyone. We were talking commodities, we were talking oil with Jeff Currie from Carlyle Group, and he's still with me. Jeff, thanks so much for sticking around. Look, we're talking about the Middle East. We're talking also about the dynamics of how much oil the U.S. actually produces. What's your take on copper? Again, this is a story that's very much tied to China and the new stimulus coming from there.
It is the oil story upside down. Copper is long-term bullish, and all the investors buy the long-term bull story. In fact, 5-year copper after the stimulus announcement hit an all-time high. Near term, there's a surplus, and it's being driven by the fact that smelter production of refined metal is higher than the mine production, which, by the way, is unsustainable. That's helped create a surplus at the same time you had weak Chinese demand during 2Q and 3Q. So the question is, how quickly will this stimulus eradicate that current surplus and make that longer-term story true, which, again, is just the opposite of what we have going on in oil. Our view is this is the real deal. It's a shift by the government, and if they're not taken seriously by this, then it's saying that, their credibility is being shot. And I think you look at the Shanghai Composite, it was down yesterday far less than the Hang Seng. It tells you that onshore they believe him, offshore they don't. And I think the what matters is the onshore group. And I think the way somebody put it is, before there was the concerns that Xi Jinping was idealistic in this, now it's very clear he's pragmatic, and that he's putting a floor on that property market. If he puts a floor on that property market, then all that investment in green capex goods begins to start driving growth, and I think that's the case right now, which will tighten the market and put upward pressures on near term.
But Jeff, so where do you think we are in the demand cycle for copper?
Oh, this is just chapter one of the story of green transition. When we think about energy transition, copper is the bellwether. I like the statement they say is, copper is the new oil. When we think about, Dr. Copper, what is he a PhD in now? Environmental economics, and he's telling us what's going on in, the energy transition. And I think at this point right now, demand everywhere in the world is positive. It's turning up. The IEA published a report about renewables yesterday, and you can see it turning up everywhere in the world. And I think the one thing that came out with China is they've already hit their targets on renewables and are continuing to go ahead. And I think the big issue is grid. And grid is very copper intensive. And, the grid focus, in fact, in that report, they emphasize the need for investment in grid, and you can see it coming up. But, I think, right now we're in the early innings of this game.
So what does this mean for price? If we don't have enough of it at the moment, are
we going to see new highs above $11,000 a ton this year? I think really high. We got close to it a week ago before this, this announcement. And the back end is at an all-time high. We still stand by our longer-term forecast of 15,000, which I think in the end is going to be relatively low. Now you have an environment where the underlying economic forces are reinforcing it, and then you have the energy transition story on top of that. The story it's there. By the way, I know I've been here telling you the story for the last 3 years. It works here, it works there. Ultimately, one day we're going to walk in, and it's just going to go straight up. And I'm very confident in that story. The question is, you just got to be there. It goes back to that point we're talking about oil. The investors are not willing to hold the position. They want to see it. And right now, we have a surplus.
Talk to me about gold. What do you do with gold right now?
Not to say love commodities. It's another one. Here's a point. It was about a week ago. We hit the all-time high in real gold prices relative to even in the 1980s, which tells you the environment we're in. So, but I think another point here is think about gold, how big that market. It's in that $13-14 trillion range. It's FX reserves of gold are now larger than the euro. well, particularly in the size of the move, which tells you, the diversification inside banks, central banks is going to continue. The Chinese are continuing to buy. You now have Western buyers focused on it. So the underlying fundamental picture, 3,000 gold, I think, is very foreseeable.
Jeff, help me out with the U.S. election, because I have a number of market participants who say, look, the outcomes of the U.S. economy will change, and also foreign policy, but no one's really able to pinpoint exact policies right now, also given that the race is so close. What does it mean for commodities, depending on who's in the White House?
I think, when we look at China, the situation there is part of why they're waiting is they want to see the outcome of it as well. And if they get an outcome of Trump, they probably focus more on domestic consumption issues and less on exporting green goods. If it's a Harris victory, they focus on making investments in more green goods. By the way, the amount of investment that they've made is just astonishing. Even going forward, one out of every 2 megawatts of renewable installation is going to be in China, and it's going to be Chinese-produced goods. And so I think it has a lot. Are they going to continue this bet on the green capex goods? Has a lot to do with the outcome of the election.
Jeff, thank you so much, as always, for joining us. What a
excellent,
good conversation,
as
always. Jeff Currie from Carlyle Group. Now, staying with commodities, Rio Tinto has also won board approval to buy Arcadium Lithium in an all-cash deal that values it at $6.7 billion. Now, the deal boosts the world's second biggest miner's bid to become a major producer of the crucial battery material. So let's discuss this and some of the day's other big corporate news with Bloomberg's Charlie Wells. Charlie, we have a lot of corporate news, so let's start with Rio Tinto. How big is the deal?
Good morning, Francine. This is a huge deal, and this is Rio's largest acquisition in 17 years. And it's striking because lithium has actually been in something of a downswing this year. So in a lot of ways, this is sort of an opportune moment to swoop in and get that rapid exposure to lithium. This year there's been an oversupply, there's been cooling demand for EVs, but this is, if you look at it, a great time to pick up a company whose shares have been down about 50% this year.
Charlie, what's the latest with Commerzbank?
We've got twists and turns coming everywhere. So this is there's a new report in La Repubblica citing unnamed sources which say that Deutsche Bank may hire Morgan Stanley for some advice on Commerzbank. Of course, that approach by UniCredit. And look, executives at Deutsche Bank have said that they are not interested in making moves here. But of course, the largest bank in Germany is going to potentially want to get some advice if there's some activity in its backyard.
Okay, a bit of luxury. Gucci has a new chief executive.
Yes, exactly. So they have named Stefano Contino, who has a background at Louis Vuitton, a background at Prada, in communications and image, and he is going to take the reins in January of Gucci, which has been struggling. There's been softening demand for luxury goods, particularly out of China, and so analysts say this new chief executive has a lot of work to do, and if we want to look ahead, we need to think about what this might mean for the creative director, Sabato da Sarno, who's taken a more minimalist direction at Gucci. Does that continue? That's the big question going forward.
All right, there you go. Minimalist versus maximalist in luxury. Charlie, thanks so much, as always. Coming up, more trouble for Boeing as talks with its largest union collapse for a third time. We'll give you the details next. And this is Bloomberg. Well, Boeing has withdrawn its pay offer for 2 unions, saying talks just don't make sense now. Meanwhile, S&P said the plane maker's debt may be cut to junk on strike concerns. We're now joined by Sid Phillip. He's our global aviation reporter. We're just, saying, Sid, how tough it is for Boeing at the moment. Why did Boeing pull its offers to the unions?
So Boeing and the union they resumed talks this week after 2 weeks of a stalemate in their whole negotiations. The union's been on strike for 4 weeks now. And that's basically damped production. And so Boeing went into negotiations with the union and a mediator on Monday. And yesterday, after 2 days of negotiation, they pulled their offer. And they said that essentially the union was asking for unrealistic demands. And essentially that's why they decided to withdraw their offer and said that the talks don't make sense at this moment.
So what has the union said in response?
So the union is obviously saying the opposite, saying that Boeing was unwilling to negotiate. Boeing came out with an unprecedented offer where they came out with 30% an offer for 30% to the workers without going through the unions, which really angered the unions. And so the union said that they weren't willing to budge past that offer that they made.
Yeah.
And so there's a big sort of gulf between the two sides, and that's really keeping the strike going.
So, but Sid, how crucial is this for Boeing actually to get a deal?
It's absolutely vital for Boeing. I mean, Boeing's burning through cash every day that the strike keeps going. And, I mean, there's estimates that it's about $100 million a day. And S&P has sort of threatened, they've said, yesterday they came out saying that if Boeing isn't able to resolve the strike and if the strike goes on longer, they could be forced to downgrade them. And that would be really, really difficult for Boeing because, I mean, once they go into junk status, the borrowing costs go up and it becomes that much more harder to get out of the hole that they're in at the moment.
I mean, I was going to ask you, I mean, junk debt rating, the headline is pretty worrying, but how difficult is it actually in practice to borrow?
It would be much more expensive. So essentially, it'd be much harder. You might not be able to access the same institutional sources of funding, and also you'd be much more expensive. And Boeing, with a $57 billion pile of debt, it would be really hard for them to sort of plow through that with borrowing costs going up, especially as they haven't really got cash flow until they start delivering airplanes.
Yeah. But so does it put the recovery at risk, or does it just delay it?
It does definitely put the recovery at risk because at this moment, Boeing's got a huge backlog, and everyone's sort of taking comfort in the fact that it is a duopoly, and Boeing's backlog runs to the end of the year. At the same time, I mean, the longer that the backlog is not fulfilled, you have angry customers, you have penalties that potentially are on the line, and the fact that you've basically not been able to generate any cash because you only get cash when you actually deliver those airplanes to the customers. And without those deliveries, it's impossible for Boeing to start generating cash again. And so for them, it's vital to be able to get production back again, and that's conditional on a deal with the workers. So it's fairly it's a big problem for them, but at the same time, it's a fairly easy sort of fix in terms of getting that sorted out and then getting it on.
Sid, thanks so much. As always, Sid Phillip there with the very latest on Boeing. Up next, the Bloomberg Brief, Vonnie Quinn in New York, Manus Cranney in Dubai, and this is Bloomberg.